If you've ever wondered whether direct recognition or non-direct recognition whole life insurance company gives you the most long-term value, I'm going to show you the exact side-by-side comparison that I shared with a real client less than 2 weeks from the recording of this video. I'm not going to show you theory. I'm not going to show you a conceptual explanation. I'm going to show you real numbers from a real case so you can finally see the truth behind how this works. So let's jump right on in. So here's the big misconception. Direct recognition means that you don't earn dividends on loan dollars. And it kind of sounds logical, but it's not accurate. It's actually false. You do earn dividends on every dollar in your policy. Direct recognition simply adjusts the dividend rate on those loan dollars. So non-direct recognition doesn't make such adjustments, okay? But that doesn't automatically mean that non-direct recognition is better for long-term performance though. And that's exactly what the comparison that I'm about to show you reveals. So for this client, and for many people who use their policies actively, the big question was, if I'm planning on taking loans, which structure actually gives me more cash value over the long run? And so I ran an apples to apples comparison for this particular client, again, less than 2 weeks ago. And I used two different life insurance companies. We looked at Penn Mutual, which is a direct recognition life insurance company, and we looked at Lafayette Life, which is a non-direct recognition company. They're the same funding, they got the same loan activity, we have the same timeline, and for the same exact person. The only difference is how each carrier treats loan dollars inside of the policy in terms of the dividend calculation. So let me show you exactly what I showed him. All right, so the first illustration that I want to show him was what it would look like in terms of the cash value accumulation in the event of no loan activity whatsoever, right? And so what we're seeing here is a premium outlay of $25,000 per year. The ultimate goal for him was to do 25 grand for him, 25 grand for his wife, $50,000 in total annual contributions. So we got 25 grand a year, okay? In terms of break-even points, we're looking at by the 6th year, 150 goes in. We have $154,000 available by that point in time. But let me just highlight what the long-term cash value looks like. So let's look at year 20 as an example. So by the time $500,000 had been contributed to this policy over 20 years, what he's going to expect to see in there is somewhere in the neighborhood of $820,786 by that 20th year. All right, so now we want to look at the Lafayette Life Insurance illustration. So in this particular case, again, still same contribution, $25,000 per year. And so by that 20th year, we're seeing that from an apples to apples comparison, both of them have had $500,000 contributed to either policy. But what we're seeing here is even without any loan activity whatsoever, we're now seeing $765,044 by the end of that 20th year. That's over a $55,000 difference over the course of 20 years. And I would admit that for some people, that's not that big of a difference by any stretch of the imagination, but for others, it probably would be a big difference. And I'm just kind of wanting to show you the difference in efficiency over both of these policies over the course of 20 years. So now what we want to do is we want to pivot and we want to take a look at loan activity within Penn Mutual policy, and we'll look at the Lafayette Life Insurance policy in a moment. So we're not taking any loans in this particular policy until the 3rd year. So in the 3rd year, $20,000 of income, you see this new column added of income taken. And so specifically, this is a policy loan, right? And so as of today, the loan rates for Penn Mutual, and it's in this illustration, we're looking at 5.3%. And so the loan balance by the end of that first year would be $21,060, again, if you're accounting for that loan. And so then I went on and said, well, how about what if you didn't pay it back for that first full year and then you let it go for another year as well? So then the loan balance by the end of that 4th year would be $22,176. But then in that 5th year, what happened here is I decided to go ahead and just pay all of that off, including the interest, okay? Then a few years later, in year 7, we take an even larger loan. We take a $50,000 loan. And so after not paying it back until the end of a 2nd year, well, now we're looking at $55,440 in terms of a total loan balance, right? So this is the loan activity. Let's actually scroll down to year 20, and I'm going to show you the cash value that you see here within this policy. So the cash value now is $816,735, which is a difference of about $4,000 in terms of where we would have been if it wasn't for him having that loan activity. But that still means we're over $50,000 ahead of where the Lafayette Life Insurance policy would have otherwise been, even if there was no loan taken out against that policy. And then what I wanted to go ahead and do is show my client what that same exact loan activity would result in at Lafayette Life, which is the non-direct recognition loan company, right? So again, $20,000 loan in the third year. There's interest accrued there. At the time of this recording, the interest at Lafayette Life is 6.75%. And so the loan balance by the end of that third year, we're looking at $21,350. And then there's more interest accrued in the year following. And so by the end of that fourth year, we're looking at $22,791. And then the same loan activity, again, here in the seventh year, $50,000, we have that loan interest credited or added to the loan balance. Then a loan balance of $53,375. We'll let that go just another year, just for the sake of example. And then $56,978 is the total amount that needs to be paid back at some point if they choose to. And again, what we're seeing here is that that was paid back. And so the cool thing about non-direct recognition is that in that 20th year, we're seeing $765,044 of cash value by the end of that 20th year, which is the exact same number that we saw in the other illustration, $765,045. That goes to show you that non-direct recognition has no bearing on the dividend interest rate that's credited to these policies. So the moral of the story, and what we ended up finding, is that even with ongoing loans, the direct recognition carrier produced more total cash value in this scenario. This is the part where people's assumptions kind of start to shift a little bit, which is actually good because we want to see what is the best long-term performance in cash that you have access to between whether it's direct recognition or non-direct recognition. Now, here's the reason this matters so much for this particular client that I made this for, okay? He's in his mid-30s. His business is growing fast. He's saving $50,000 per year on the low end. He's planning on using loans for future business opportunities, right? He had absorbed some of the very strict infinite banking ideology through his education, and specifically this whole idea that non-direct recognition is always better. But when he saw the real numbers and when he saw the direct recognition still produce higher long-term cash value, even with the loans, it ultimately just kind of clicked for him. He ended up choosing the design that aligned with his goals, not necessarily the ideology. And that's the whole point of the comparison. And the real takeaway is this: direct versus non-direct recognition is not about which is good or bad, which is better or worse per se. It's about which company gives you the best results based on a few things, based on your funding, your loan usage, your goals, and the carrier's internal structure. So if you want to see how these options play out in your own situation, you can go ahead and schedule a call with our team here at BetterWealth, and we'll walk you through your own numbers step by step. So thanks for watching. We'll see you in the next one. Hey, it's Demetrius. Just wanted to pause the video real quick because if you're a high earning professional, an entrepreneur, someone who just wants more control over your money, we offer something called a clarity call. It's a one-on-one conversation where we walk you through how an overfunded whole life insurance policy could help you build safe, liquid, tax advantage foundation for your wealth. There's no pressure, no fluff, no hype, just real clarity on whether this strategy is right for you. So go ahead and click the link in the description or the tag comment below, and we'll walk you through exactly how we can help you.